Welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. Joining me on the desk at the Nasdaq Market site in Times Square, New York City, we have Max Cabasso, managing director on Nasdaq's Market Intelligence Desk, Caleb Silver, editor-in-chief at Investopedia, and we have Prince Dykes joining us. He's founder and CIO of the Royal Financial Investment Group. We're here to discuss investor sentiment and where they are buying and selling. It is great to have all of you with us. Welcome to the show. Welcome back to the show. And it's interesting, Caleb. Investors are staying invested, and that's encouraging, but they're cautiously optimistic.
Yeah, cautiously optimistic because there's just been so many headlines, so much headline risk and volatility that as an investor, you don't know what to do. So sometimes the best thing to do is stand there and do nothing, as Jack Bogle likes to say. And that's what a lot of them have been doing. But you've also noticed that individual investors, some of them, have been searching opportunities to buy the dips in some of their favorite stocks. We have seen that a fundamental difference between what individual investors are doing and what global institutional investors are doing, who are still pretty skeptical, still pretty scared. They're managing other people's money. I totally get it, but they've missed a lot of this rebound. So fascinating.
Yeah, I mean, we saw that over COVID as well. Some of the returns in between. I mean, if you look, we had the immediate sell-off in the beginning, but if you acquired shares in your 401k on the acceleration to the upside, that's where longer-term investing and staying invested makes sense.
I think that it was a shock to the system. President Trump came in. This is the most connected people have been to a president. Every day he's tweeting, letting you know what he feels, what he thinks, and people wasn't used to that. They're like, whoa, what is going on? The shock has come to the system. But now people, you're seeing that sentiment change because people are kind of getting used to it. They're like, oh, this is what's coming out of the White House. Remember early in the year when we started with the tariffs? But how many of those tariffs actually got implemented, right? So now people are like, oh, you start hearing the words taco get thrown around. Oh, the tariffs, he's just going to scare everybody off. So now the sentiment is the confidence of people being adjusted to the new president coming into the market. And, you're seeing that now with the massive volume to the bullish side come in, started happening in April.
Yeah.
Yeah,
I mean, Max, we talk about this all the time on the desk. We're up, what, 3-4%-ish on the S&P. So it sounds like a flat year, not much going on, but when you peel back the layers, if you were under a rock since January, wow. I mean, there was some unprecedented trading in this environment.
Tariffs, potential wars, again, new administration coming in, spending bills. When you have all of that, rate cuts, no rate cuts, inflation coming back, it's not coming back, the amount of headlines that have come across that in a, I don't want to say normal year, maybe pre-2020 year would have kind of really shaken beliefs in investor sentiment. It's short-term blips now. It seems like algos are the ones reacting now to the headlines and the risks. You see the immediate sell-offs. You watched it over the weekend or last week when the bombs really started to fall in the Middle East. You saw kind of risk-off sentiment in futures and in crypto space, and then it gets bought back. I'm just like, we're just going to go through it. We just get through it. COVID, we're just going to get through it. And you see that a lot of the talk of 2020, we had that initial sell-off. We got that first rally, almost reminiscent of 2008, 2011. We saw those kind of dips where we get a little bit of dead cat bounce and then sell off again. Everybody was calling for that after 2020. That we saw that first initial rebound off the COVID lows. A lot more institutions were like, hey, dead cat bounce, we're going to retest the lows here. And it just never did.
Yeah.
Retail got involved, individual investors were involved, and we're not getting those kind of retests. You get the initial move down, and it gets bought up, and you kind of flatten out for a bit, you get steady, and then it's kind of back to the previous trend of we're trading higher. The mega caps keep getting bigger. Small caps still kind of underperform, but the names have still worked. So people are staying invested because it's still working.
So Caleb, there's a couple things here. Makes you question, what if we did not have the generative AI narrative from November 2022? Where would we be now? Would we have that same kind of leadership? And then number two, for as long as you and I have been covering financial media, not talking about politics was the way you were supposed to manage your coverage. You can't not insert policy into these conversations now.
You can't, and politics is the narrative right now because it is a noisy headline environment, but the market keeps churning along. So whether that's algos or what I like to think of as the relentless bid, what do we do every 2 weeks, most individual investors? We put money into our 401k or our IRA. We buy the same stocks or index funds. Those are heavily weighted by the mega caps. The mega caps are now very AI heavy. So if we didn't have that narrative, we might not be here with the volume. But this is just this relentless bid over and over again. And you're right. We had a 19% drop. Didn't even fall into a bear market. It was a cute little correction and it was over. I mean over, because the headlines snapped back and institutions poured back in. So if we didn't have that narrative, the AI narrative, who knows where we'd be right now. But that was the beginning of that bull market. Now we have the beginning of another bull market, with the market near record highs yet again. And not much has really changed except massive policy announcements, but we haven't even seen those play out yet.
So, Prince, from an advisor perspective, what are some of the concerns clients are coming to you with? How are they managing this environment? What kind of hand-holding do you have to do?
Oh, one of the biggest things was, especially in the early year when we had the tariffs talks, when President Trump came in, we had the massive layoffs. We had so much going on at the time. You had Ukraine, you had Russia, you had the tariffs. So it was just complete chaos.
Right.
So much happening at one time. We threw the whole kitchen sink. So most of the things was the clients were worried about what's going on. Clients don't call you in a bull market. Everybody's a genius, right? They don't even care what's in their portfolio. They look at what's, oh, it's growing. Thank you. I got the best advisor in the world. But when they start to lose, they're like, oh, what's going on in there? What's in my portfolio? Are we doing this? Are we doing that? But that's a traditional sense that I've seen on the retail side, and being a financial advisor, when you start to face bear markets, that everybody starts to, hey, well, am I protected? Is it going to go to zero? Am I going to do this? So the thing is, like Caleb said earlier, Jack Bogle, do nothing, sit in the seat. Now you're looking at, you fast forward now to June, everybody's like, oh, thank you. I should have invested more. Everybody loves to invest in the bull market, but when it's the bear time, everybody's like, I don't know.
Yeah.
It's clear to see when the rearview mirror, right? Once you can look back and see, oh, wow, that was a major dip. But the trickiest part today, we don't know where we are. I mean, at the tip of the market, we're at an all-time high.
Yeah.
It's just a tip, running into another bull, or it's just a tip headed into a bear. When we pass through it, we can all look back and say, man, I should have doubled down. But having the client say, hey, stay calm, do nothing. Me, I'm a bull, I'm an optimistic guy. I'm like, we'll figure it out. And I go back to what Warren Buffett said, for 200 years, it's been a great mistake to invest against America, to bet against America. Don't start today.
Caleb, it's interesting. One of the top stocks within the investor sentiment survey at Investopedia is Berkshire
Yes.
Hathaway. I thought, and this survey, if I understand it correctly, is directed towards a younger set of investors.
It's all of our newsletter readers, so 18 to 80, but that tells you that's an older investor who will, and the question was, what stocks do you own in your portfolio today, and which ones would you buy and hold today for 10 years? I was very surprised to see Berkshire Hathaway at the top of that list, especially now that we don't have the Warren Buffett premium so much in that stock anymore. So you saw that. You also saw a Palantir there, so that tells you a savvier new investor is aware of some of the newer companies. But then you also saw the usual stocks that people have grown up with in this bull market, the Apples, the Microsofts, the Mag 7 definitely. And when we buy and latch onto those stocks, it's very tough for us to sell them. We were just talking about this off camera.
Yeah.
You have a big position in these stocks, you're loath to start cutting away from it a little bit, but that's kind of what you have to do in some cases when you build really big positions.
Which is interesting because we had a student group here earlier in the year, and one of the kids was 10 years old. He got for Christmas, he got his first $1,000 to invest. And I'm like, oh, what stock did you invest? Expecting to hear Apple, Nvidia, Berkshire Hathaway. You were here with me that day, Max, and I was blown away. And I think part of it is because of services like Investopedia, where people have more access and exposure to the markets at their fingertips. But Max, you had mentioned algorithms before. I also think what we're seeing, because investing has become such a community-based type thing, whether it's social media or individual platforms, I'm sure that has to influence trading patterns.
Yeah, for sure. Just the sheer amount of information that is available to an individual investor because of the different platforms that they're on, whether it's on Reddit, it's on X, Investopedia, whatever group you're in, there's information out there, and more people starting to get that information. They're more informed and make smarter decisions, and more of a kind of a herd decision because you see it working. It's also that kind of FOMO trade. You see it a lot. People post their accounts, hey, look how much I'm up. Everybody else sees that and kind of wants to get involved. So it is that kind of crowdsourcing of investment ideas and investments and putting in. And when it works, everybody kind of sticks with it. So big thing is time horizons, though. I think that gets missed a lot. When you're putting money in, how long you're willing to sit on it. Is it a short-term trade? That's the only issue you run into with kind of some of the herd mentality. Sort of everybody has a different position. If you waiting for somebody to tell you when to buy something, or are you then waiting for them to tell you when to sell it? So again, we haven't run into that yet because everybody's just stayed invested and we haven't really seen any panic selling. We've seen some selling. I do think a lot of that's more electronic driven, where it's typical headlines, how they're programmed, how the market used to react on certain headlines, certain functions. You're seeing it short term, but then it gets kind of bought back up. We'll see if we get a real turn that's prolonged and not just a quick 19% drop and rebound. If we see a prolonged move lower, if that tends to hold, but every indication we've seen so far has been investors are willing to sit and wait. They're learning. They're not doing the panic selling where everybody used to count on that. Okay, retail is going to panic sell. We're going to step in and buy it on the cheap. That's not happening in the past few years.
So speaking of learning and being well informed, tell us about the Global Children Financial Literacy Foundation, which we have a big passion here for Finland.
Oh, thank you, thank you. Global Children Financial Literacy Foundation, as you can see here, we have kids here today. This is actually our 10-year anniversary of our first book series that we wrote teaching kids about investing with my son and I, Wesley, over a decade ago, from June 15th to now when we self-published. See, what he just said about panic selling, that's because the retail investor is more educated now. So now I tell people, well, how did we get to this point of people not knowing about investing, finances? This is where we come from. We come from America, right? So what we do is we teach kids about investing, credit, insurance, real estate, and we attack these at the youngest age possible to introduce them into these topics. So, and we turn kids into the first-time shareholders of stock as well. We do that through our book club, and we teach kids as well. We have, classes, so we've been doing it. The foundation got started in 2017 with Chad Davis and myself, and it's just all been grassrooted, started out of my basement. I saw an opening in the market that was like, Wesley was bringing home books. I'm like, dude, these books are cool, but you need to know about investing, credit, insurance, real estate. That's what real life is about. So I didn't want to look at the world and say, hey, you shouldn't be teaching this. So I said, you know what? I'm going to do it myself.
There you go.
So I just started it by myself, and we just...
So from your basement to the Nasdaq Market site, and now the kids are going to watch the closing bell. So this is a memory they will have for the rest of their lives.
This is crazy.
Because you brought it here,
That
which
is
I think
crazy.
is incredible.
Here at the Nasdaq.
Yeah.
So from the basement to the Nasdaq.
Right, but that's, I remember...
Good memoir title.
I know, right?
From the basement to the Nasdaq. I remember the first time here at the New York Stock Exchange, my very first bells I went to. It's something you do not forget. Caleb, I also want to talk about investors, readers on Investopedia. If they had an extra $10,000 bucks.
Yeah, this is the ultimate discretionary question. This is not, if I just gave you 10 grand to do anything you want with, what would you do? This is for investors saying, if you had 10 grand now, where would you put it in the market? Would you buy stocks? Would you buy ETFs? Would you buy crypto? It's individual stocks. And that just tells you people are a little bit more willing to take a risk now with discretionary money. It doesn't tell you what they would do inside their normal 401ks or their IRAs or their brokerage accounts. That extra money, people are willing to take the risk on individual equities. Why? Because they have seen stocks, their favorite stocks, the NVIDIAs of the world, the Teslas of the world, the Palantirs, the Amazons, et cetera, take dips and then rebound back very quickly. So they would be a little bit more promiscuous with that extra money right now. But right underneath that would be ETFs, which is another way of saying, okay, maybe I won't take a big chance, but I still want to be invested. So I think the retail individual investor crowd wants to keep investing because it has been working. And as far as why the market keeps kind of not, falling apart here, it's just like I said, relentless bid every couple of weeks, and all that chatter in social media and everywhere else, that produces a ton of data. That data is being scrubbed by everyone out there who has a smart algorithm and AI to get signals to buy or sell stock. So we are in the machine, and we are the machine.
If it was me, I would do a thematic ETF. I don't know. I'm still, even with discretionary money, single stocks. I mean, there's so much to choose from. If you're thinking about defense tech, which I think is such an interesting space to cover. Max, on the Market Intelligence Desk, you are speaking to Nasdaq listed companies all day long, and I believe tech is one of the areas that you're covering. How are corporate management teams perceiving the environment right now?
I think it depends on where you sit. As we've talked about, the large caps are in a really good space. Software started out really well, cooled off a bit, and now that's kind of come roaring back as that kind of secondary trade for AI. I think it does depend on the space. Small caps are still hurting a bit more. The rate environment is still not where they would like it to be. They're able to manage through it. There was hope that rates would be a bit lower for them if they're tapping the debt markets. They're able to manage through it. There's been just, again, a lot of headlines, but not a ton that has really impacted the corporate balance sheet at this point. So I think we're kind of in that little bit of a black box right now.
Yeah.
Buybacks are cool. That's getting closed out for now. Earnings are not going to pick up for a bit. We have the holidays coming up, July 4th, so it's going to be quieter. We do have the Russell rebalance on Friday, so that'll be a big event. But it does depend on where you sit, what area you're in. Software is looking really strong. And again, anything AI and crypto related is catching a big bid. We're seeing a lot of, not copycats, but a lot of corporate treasuries that are now adding crypto to their balance sheets, becoming crypto treasury companies. Not just Bitcoin. We're seeing it in Ethereum. We're seeing it in Solana. So that process is moved. We're seeing a lot more turn to that, and that is the small cap space, trying to kind of get a little bit of juice behind the names, whether they're going all in on it or just dabbling with it. It depends, again, on the space, but software in particular has been strong, and they are looking for a really good back half of the year. So large, mid to large cap in the software space is looking like a better space right now.
Yeah, it's interesting that we haven't done anything with interest rates, but my savings accounts, I get emails every 2-3 weeks that it's another 15 basis points lower, another 15 basis points lower. I
Slow drip. Another reason the stock market has been rising. It's like money needs a place to go, and it's going to go to the highest ground possible. And if we lose savings rates here or yields fall on treasuries, it's the stock market or crypto.
Yeah. Last thoughts here. What's your outlook? How are you keeping people invested, encouraged?
Me, I look at it this way. I'm a bull all the way. So I tell everybody, I'm a little biased, is my opinion here. The backbone of our economy, some people may agree to me, may agree or disagree, is the U.S. military. So as long as we got the world's strongest military, I'm bullish on the market. So I tell people, get invested and stay invested.
All right. Appreciate all of your insights. Thanks for joining us on Trade Talks, and thanks for joining us from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.